Last year, CRA hit 133,000 Canadians with TFSA penalty taxes, over $166 million in a single year, and the number of people getting caught has quadrupled. Most won't know until they get the letter, and by then, the penalties have already started compounding. The average bill works out to more than $1,200. Here's how to check if you're one of them before the envelope shows up. Welcome to Canadian Finance with Volney. Every Saturday at 7 a.m. Eastern, I break down a specific Canadian finance strategy, the tax accounts, the wealth moves, the CRA rules that actually matter for people building money in this country. No hype, no clickbait, just the math and the playbook the top earners actually use. If that interests you, subscribe. That's the deal. Today's breakdown is a serious one. And the people who tune out halfway are the ones who leave real money on the table. The ones who stay to the end keep it. Let's start with the mistake that costs the most people the most money. Over-contribution. Your TFSA has a contribution limit. It goes up every year. In 2026, it's $7,000. If you've never used a TFSA before, your total lifetime room right now is as much as $109,000, depending on when you turned 18 and became eligible. Here's where it breaks. A lot of people think the limit resets on January 1st, like a clean slate. It doesn't. It accumulates. So if you contributed $6,000 last year and took out $4,000 in November, you don't get that $4,000 back in room until the following January. But people see the withdrawal hit their bank account and think, great, I have room again. They recontribute in December, and CRA flags it as an overcontribution the moment it posts. The penalty is 1% per month on the excess amount. So if you accidentally put in $6,000 too much and you don't catch it for 6 months, that's $360 in penalties. If you don't catch it for a year, it's $720. And CRA doesn't send you a warning. They send you a bill. Here's the second layer of that mistake. A lot of people track their contribution room using their tax return summary. That number is often wrong. CRA's systems lag behind real-time transactions by weeks, sometimes months. So if you made a withdrawal in December and you're checking your notice of assessment in January, it might not reflect that withdrawal yet. You think you have less room than you actually do. Or worse, you think you have more. The only way to know your real-time room is to log into CRA My Account and check the TFSA transaction review. That shows every deposit, every withdrawal, and the exact date CRA processed it. If you've never logged in there, you're flying blind. Now let's talk about the mistake that gets people who think they're being smart. Day trading inside a TFSA. CRA has a rule buried in the Income Tax Act that says if you're carrying on a business inside your TFSA, the income is taxable and the TFSA loses its tax-free status. They don't define carrying on a business with a bright line. It's a facts and circumstances test. But the case law gives us clues. If you're buying and selling stocks multiple times a week, if you're using margin or leverage, if you're holding positions for less than a few days at a time, if your trading looks like a full-time job, CRA can argue you're running a business, not investing. And when they do, they reassess every dollar of gain as taxable income. They also hit you with penalties for underreporting, because you didn't declare that income on your return. There's a famous tax court case. An investment advisor turned $15,000 into $617,000 inside his TFSA by day trading penny stocks. CRA reassessed the entire $602,000 gain as business income, a six-figure tax bill. He fought it in court. He lost. The court said, the frequency, the leverage, the time spent, this wasn't investing. This was a business. And the TFSA shelter doesn't apply to business income. Now, most people aren't day trading, but a lot of people are doing something adjacent that can still trigger a review. They're buying and selling the same stock over and over to tax loss harvest or rebalance. If you sell a stock at a loss in your taxable account and immediately buy it back in your TFSA, CRA can call that a superficial loss and deny the deduction. If you're moving money in and out of your TFSA every month to chase performance, you're building a transaction history that looks like trading, not long-term investing. The safe play? Treat your TFSA like a buy and hold account. If you want to trade actively, do it in a taxable account where the rules are clear and you can deduct losses against gains. Here's the third mistake, and it's the one that surprises people the most: prohibited investments. Your TFSA can hold almost anything: stocks, bonds, ETFs, mutual funds, GICs, even certain private shares. But there's a short list of things it can't hold. And if you accidentally buy one, the penalty is a one-time tax of 50% of its fair market value, charged the moment it lands in your account. The most common prohibited investment is a private company share where you or a family member owns more than 10% of the company. Let's say you start a side business, you incorporate it, and you transfer some shares into your TFSA to shelter the growth. If you own more than 10% of that company, or if you and your spouse together own more than 10%, those shares are prohibited. CRA will assess a tax equal to 50% of their full value the moment they land in the TFSA. The second common one is a non-arm's length debt. If you lend money to your own corporation and hold the loan inside your TFSA, that's prohibited. If your TFSA buys a mortgage on a property you or a family member owns, that's prohibited. The third one catches people who are trying to be clever with real estate. You can't hold a direct ownership stake in real estate inside a TFSA. It's not a qualified investment. But people sometimes try to work around that by setting up a holding company, having the TFSA own shares of the company, and having the company own the property. CRA treats that as a prohibited investment if you control the company. And they also treat the rental income as business income, which means it's taxable and you lose the TFSA shelter. The penalty for a prohibited investment is a one-time 50% of the fair market value, plus a 100% tax on any income or gain the investment generates while it's in the TFSA. And you have to report it on a separate TFSA return, the RC-243, by June 30 of the following year. Most people don't even know that form exists until they get a CRA letter asking where it is. So how do you know if you've made one of these mistakes? First, log into CRA My Account and pull your TFSA transaction review. Check every deposit and withdrawal against your own records. If you see a withdrawal that you recontributed in the same year, flag it. If your total contributions since 2009 exceed your cumulative limit, you're over. Second, look at your trading activity. If you've made more than, say, 20 trades in a year inside your TFSA, and those trades were short-term holds, less than 30 days, you're in the gray zone. CRA might not come after you, but you're on the radar. If you've made more than 50 trades, you're almost certainly going to get reviewed if your account grows significantly. Third, check your holdings. If you own private company shares, if you own a loan to a related party, if you own anything that isn't a publicly traded security or a standard mutual fund or ETF, pull the prospectus or talk to your accountant. Make sure it's a qualified investment and not prohibited. If you find an error, you have two options. If it's an overcontribution and you catch it before CRA does, you can withdraw the excess immediately and ask CRA in writing to waive the penalty. CRA grants waivers if the mistake was unintentional and you fixed it quickly. But you have to ask. They don't waive it automatically. If it's a prohibited investment, get it out of the TFSA immediately and file that RC-243. Here's the part almost nobody knows. If you remove it before the end of the year after the tax hit, and you genuinely didn't know it was prohibited, CRA can refund the entire 50% tax. Leave it in and you pay full freight. If CRA sends you a letter before you catch it yourself, you're already behind. The penalties have started. You still have the right to appeal, but your chances of getting a waiver drop significantly once they've initiated the assessment. Here's the psychological shift. A TFSA isn't a set-it-and-forget-it account. It's a tax shelter with rules, and the rules have teeth. The reason so many Canadians end up with errors on file is that the system doesn't warn you when you're about to cross the line. It just sends you a bill after you've crossed it. The good news is that the fixes are simple if you catch them early. Check your contribution room once a quarter. Treat your TFSA like a long-term investment account, not a trading platform. And if you're holding anything other than plain vanilla publicly traded securities, get a second opinion before you assume it's allowed. The CRA letter doesn't feel real until it shows up, but the math behind it is running every single month. So check your account today, because if you're one of the 133,000, the clock is already ticking. One last thing. I'm building a complete library of Canadian wealth strategies on this channel. RRSP optimization, TFSA stacking, FHSA mechanics, mortgage moves, the legal CRA tools the banks won't explain. A new piece every Saturday at 7 a.m. Eastern. The channel is growing right now, and at this size, your subscribe carries real weight in who else YouTube decides to show this to. Help us out. Hit subscribe, and I'll see you next Saturday.